Okay. All right. We are recording. And thank you all. Oh, we have, hold on. Got more people joining in the waiting room. Let me disable the waiting room. There we go. And then people will just come in as they get there. So thank you all so much for joining us. I'm here with my partner, Greg Stanek today. And it's October 14th. And I've been working on quarterly reviews all week. And you know, we're still down, but it is so much better than it was when I was sending out your March and June reviews. And it's just a whole weight off the shoulders as I'm sending you these greatly improved numbers. So with that, we'll kick off the call. With respect to the firm, things are exactly the same as they were when we did this call in July. In July, we were at 50% of capacity with people rotating in and out of the office, that everybody's here for some time. Our kids are back in school. We're about a month into that. And so far, Greg's kids have been able to stay in school the way they're supposed to. Our kids have been able to. Jonna's kids have been able to. So that makes us a little cautiously optimistic and extremely thankful. Monday mornings, we're still doing Zoom calls with the team. That's been really helpful for all of us. And we might even do that well into the future. We're wearing masks in our common space. And everything's going okay. It's still certainly not my preference to have half the people in and half the people working from home, but we've found a routine and it's just fine for now. That being said, I am going to host a mask burning party in 2021 when we don't need to wear them anymore. And you're all invited to throw masks into the bonfire that I'm going to build. So yeah, so that's coming. Okay, getting into the more real stuff, the market letter and the quarterly review. Here's how we're going to frame this call. We're going to talk to you quickly about the election. We're going to talk about why the market's up, where we're going from here, and what the market trends are. And then we'll give you some portfolio updates. As you all know, there wasn't a huge amount of activity in the portfolios during the quarter. And then we'll open it up to question and answer. So getting the big stuff out of the way first. When we sent out our quarterly letter a week ago, but we started writing it before that, we wrote in the letter that we thought that the market was pricing in a Biden win and probably a Democratic sweep of House and Senate. We think that the expectations for that within the market are even more pronounced now than they were a week ago when that letter was sent out. As Greg's reminded me so many times over the last several months, we should not succumb to believing that the way the polls failed in 2016 is likely to happen again. That was an anomalous event, and we think it's not likely to occur. So we think and hope that the election will not be disruptive to the stock market because we believe that the stock market has been in the process of adjusting to the most statistically probable outcome, which is a Biden win and a House and Senate that is Democratic. So we're expecting that statistically probable outcome right now. And we think that as that comes, what we expect to come with that is increased regulation, softening of trade tensions with China, and increasing taxes. Greg's going to dive in a little bit to the stock market and how that will respond.
Yeah, perhaps most importantly, the stock market, is looking at the short-term impact of the election. So we think most likely a Democratic sweep is the most probable event, which probably means at least a $2 to $3 trillion stimulus bill to be passed if it hasn't passed already. On top of that, there seems to be a growing consensus that the Democrats would push for a large infrastructure spending bill. In addition, even the Fed right now is encouraging Powell in his statement said he was encouraging the federal government to spend more money, which is unusual for the Fed to say that. And even with a Democrat sweep, a tax hike may be likely in the next year or two, but that's more likely to offset additional federal spending. So the market likes stimulus, and it certainly looks like it's going to get that. In addition, we still have the $3 trillion budget deficit that the federal government has been running so far this year, and also the $3 trillion expansion of the Fed's balance sheet. So there's been a lot of stimulus already, and more is likely to come. And the other impact we see from the election, if it does become a Democrat sweep, would be a less aggressive stance on trade, which should lead to less uncertainty in the market. That would be good in the short term, but perhaps will have some long-term consequences. And I think the market is probably, for now, ignoring a lot of the long-term consequences. And we look at some of the spending that's taken place and going to take place. It's pushed the debt levels of the government to quite high levels. So government debt to GDP is going to be above post-World War II levels. The budget deficit is 15% of GDP right now. Back in 2011, the S&P downgraded the U.S.'s AAA credit rating. At that time, when it downgraded the credit rating, the budget deficit was only 8% of GDP. So now we're at 15. So that could be a potential consequence. And taxes at some point will have to go up to pay for all the spending. But that's in the future, and the market is less concerned about that today. The other long-term impact is that as trade tensions soften with China, that's positive in the short term, could be negative in the long term. But overall, we believe that this should actually be really good for international stocks. Weaker dollar and stronger foreign currencies, combined with less trade tensions, while that may not be good for the long term for the U.S. economic health, but we know certainly that the economy and the market don't always trade together. But in the this should be overall positive for international stocks going forward.
Right. So, so on that rosy note, if you're asking yourself, why is the market up, knowing that if we do have this Democratic sweep, we're going to have higher taxes and higher regulation, we really need to remind you that the market focuses 6 to 9 months out. And within 6 to 9 months, we're likely to get a huge stimulus package that, Greg said 2 to 3 trillion. I think I heard a number this morning. I don't know if it's true or not. It's probably not, but that it could be even as much as 5 trillion. So I think we investors are looking at this saying, whoa, there's going to be a flood of liquidity that's going to stimulate the economy. Plus we have an easy Fed. And in addition to that, looking out 6 to 9 months, there's going to be a lot of clarity. So we think that the market's pricing that in. And right now we're really just hoping for expectations to be met. We also think that the statistically probable outcome by this time next year is that there will have been a vaccine, and it will have been widely distributed, and our lives will be back to normal, and I will have been able to burn my mask. So just in a funny note, if it sounds like we're using the word statistically probable a lot, it's because Greg and I are reading this awesome book called it's Thinking in Bets, and it's by this woman, Annie Duke, who was a professional poker player and has a PhD in psychology from University of Pennsylvania. And the timing of reading this book has been really great for us because it's reminded us over and over to remove the emotion, as we've gone through the personal side of being afraid of the pandemic, as we've worried about what the election's going to be, as we've heard talk about contested elections and smooth transfers of power and all of that. What we keep doing is we keep coming back to our Annie Duke book called about thinking about statistically probable outcomes and what the realistic outcomes are going to be. So that's been a great, very grounding source for us. I really highly recommend it. Annie Duke was one of the largest grossing poker players of all time. And the opening sentence of the book is why this book isn't about poker and just about really good decision making. All right. So anyways, one of the other really good things that's coming up is that by this time next year, we're going to know a lot more about what the real economic impact of the pandemic has been. So where we are right now is we're just starting to figure that out, right? It was only a month or two ago, maybe 2 months ago, that the extra $600 a week of unemployment rolled off. And we don't know what the next fiscal stimulus bill is going to look like. And I think getting through it and being able to reflect back on what the real economic fallout has been, that's going to be a very important part of overall healing and allowing the market and the economy and us as humans just to continue life and start to march forward. So during the third quarter, we saw significant improvement in both economic data as well as corporate earnings, and the commentary from the corporations that we heard was really promising. Now, when I say that, we heard those numbers during the third quarter, but they were reflecting the second quarter earnings results. So Greg, do you mind touching on what we heard and what the economic improvements were?
Yeah, the economy overall, it's improving much faster than anyone expected. And there's certainly a disconnect between the economy and what's going on in the virus, as the number of cases has been increasing, but the economic activity has been steadily improving faster than anyone thought. The consumer's doing quite well. Retail sales are back to, they surpassed the pre-pandemic levels back in June and continue to grow. Unemployment rate has come down pretty sharply from a peak of 15% in March down to 8% now. So economists are estimating what third quarter GDP will be. The estimates keep rising steadily. I think consensus forecasts right now are for 25% growth, but some economists and even the Atlanta Fed have growth estimates of 35% of growth for GDP in the third quarter, which is a huge number, a huge recovery. And this is spilling over to companies, that the earnings are doing much better than expected. The earnings in the second quarter were down 32%. That doesn't sound great, but we were going into the quarter expecting a decline of 44%. So they came in much better than we had feared. And third quarter earnings are coming out now, and they're already off to a pretty good start. So I think it's going to be another quarter where the decline in earnings will be less than the previous quarter, and also will come in most likely much better than the analysts are currently forecasting.
Right. So to us, really, the best thing that happened over the past 3 months was that return of clarity. And it's dramatically improved from where it was. And we're actually really excited because our companies will start to report earnings next week. So starting on, I think, Monday is our first company report. And then the next 3 weeks are just going to be flat out for us. And we think that we're going to start to see some real numbers. One of the things I've reflected upon having happened over the past 7 months as we've been through this pandemic is that looking back, what I realized was at the height of the disruption in March and April, all facts and financials were thrown out the window, things that we had relied on forever. And even during the great financial crisis in 08-09, fact and financials didn't go out the window the way they did during March and April. So if you had a company that just kind of steadily earned, I don't know, like $1.10 a quarter, $1.12 a quarter, $1.14 a quarter, all of that evaporated. There was nothing that you could rely on. And what filled the gap during that period was stories. And I know this sounds a little silly, so you can make fun of me for this if you'd like, but it almost reminded me of the olden days before there was science and medicine, when there was witchcraft and snake oil salesmen to try to cure and heal people. And those were all stories. And stories and hocus pocus come in when there isn't fact and fiction or science or medicine to rely on. So what I'm most excited about happening over the next few weeks is that facts and financials are going to re-enter our dialogue in a very, very meaningful way. And I think that that will be one of the big things that starts to allow us in our portfolios to have not only continued absolute improvement of returns, but I also think the relative improvement. So where I know I touched on this in the market letter, but you have companies like Tesla, right? Tesla's a great company, makes really cool cars, makes great batteries and all that, but it doesn't deserve to be trading at 1,000 times earnings. That's just silly. And I think that as real numbers come back in, the stories and hocus pocus will diminish, and the real numbers will start to be appreciated again because we'll have renewed reminders that you can rely on facts and financials going forward. We sent out a letter to all of you on September 4th, and it was about the wild performance and valuation divergences that have taken place this year. It was really long, it was really wordy. I think it was one of the best things we've ever written, and it took forever to write, but it was about 6 pages long. And then maybe 4 or 5 days after we sent that out, one of my friends sent me some charts that basically in 3 pictures summarized the entire letter that we'd written. So I'd like to share those pictures with you real quick. Hold on. Okay, so here they are. And they are by a company called DFA. Hold on. Let's see. Okay. And what this shows is in one picture, the gist of the note that we sent out on September 4th. What this shows is on the left-hand side of the screen. Oh, and for those of you who dialed in, just let me know and I'll email these to you. They're really cool slides. But what you see is these are stocks that took up the top 10 stocks in the market when they got really out of control, like what we've seen this year with the FANG stocks, what we saw during the dot-com boom, and then what we saw in the 1970s with the Nifty 50. So what you see is those top 10 stocks, if today is day zero, if today is the line in the middle, those top 10 stocks for the previous 3 years outperformed the market by 24%. In the next 3 years, they were pretty much flat with the market. In the following 5 years, they performed worse than the market by just about 1%. And I think what this reminds us is that past performance is not a guarantee of future returns. One of the things that's been driving me nuts lately is hearing people over and over say, well, I'm sticking with the big tech trade because that's what's worked. That's what worked. You know what? This is going to mean revert. This time is not different. Financials and facts are going to matter. Cash flow is going to matter. And I think this is not to say the Amazons and the Apples and the Googles, I don't think they're going to jump off a cliff. They shouldn't. They're great companies, but they might plateau. And that's kind of what you see on the right-hand side of the screen, is that those guys kind of plateau. They don't continue to outperform the market at the same clip they did historically. So Greg, do you want to just give a quick overview of this? This is really cool too.
The next two slides are two of my favorites, and if we look at the last 3 years, this really has been, as the title on the slide suggests, an unprecedented 3-year period for value compared to growth stocks. And this is Dimensional looked at 90 years of history of returns, and for the first 84 years, value stocks, buying companies with cheap valuations, outperformed the rest of the market, or the growth stocks, by average returns of 12.8% for value, 9% for growth. Then we saw over the 7 years, in the 7 years from 2010 to 2017, we saw growth stocks start to outperform value, but it was still close. Value was up about 14%, growth stocks were up a little over 16%, outperforming but close. But then what we saw over the last 3 years is just a crazy period of returns for value, where in the last 3 years, growth stocks are up nearly 18%, yet value stocks are down 3%. This is really an extraordinary period. And then if you look at the next slide, you have to advance there. This is a slide showing the 3-year periods of return of comparing value stocks to growth stocks. So the bars on the top are periods where growth has outperformed, and the bars on the bottom are periods when value is outperformed. And this is over the last 90 years. So over the last 90 years, this has been the worst 3-year period for the performance of value stocks versus growth stocks. And that's the type of headwind we've been, since we do like to buy companies with cheap valuations and lots of cash flow. This is the headwind we've been operating against in the last 3 years, where values underperform growth by 21%. And I think one of the areas that has driven this return has been the technology sector. And we feel that the tech sector globally looks a little overheated. In the US, tech stocks are up 23% this year. That's on top of a 50% return in 2019. And even in the years before that, it wasn't like tech was underperforming. It's been outperforming for several years, but the returns recently have been staggering. It's now tech now accounts for 28% of the S&P 500 index and almost half of the Russell 1000 growth index. So it's a huge part of the market, and that's actually undercounting tech, because Amazon, Facebook, and Google are actually not considered tech stocks. They're in either consumer or the communication sector. So the importance of tech it's grown to be such an enormous part of indexes, and it's really swinging the markets. But right now it's everyone's favorite trade. There's a survey done by Merrill Lynch that surveys portfolio managers, and 42% of them said that they were overweight technology. It's one of the highest levels ever. If you watch CNBC or read the media, it seems to be every commentator's favorite sector right now is tech. And the reason why? Well, it's done well. Let's stick with it. But the result of that is that tech now trades in the US trades at 26 times earnings, and then that's not depressed earnings. That's real earning. Most of the tech companies haven't been disrupted by the pandemic. So 26 times earnings compared to the 10-year average, last 10 years, 16 times. So no one liked it at 16 times, but now it's trading at 26 times and everyone seems to be in love with tech. But we see one big risk with the tech sector going forward, and that I don't hear a lot of people talking about this, but 2021 is going to be a lot less digital than 2020. The Zoom calls you had with friends or colleagues, that's going to become office meetings and dinners and going to conferences and video games. Kids who played video games all summer in their basement are going to join camps next summer and play sports and have play dates. Sitting home and streaming TV, that's going to go back to days where you go to sporting events or to the theater or shopping malls or to the movies.
Well, maybe not malls, but.
No. Well, online shopping. Well, you will go to. Some people will replace buying things online and going to a store next year. Online shopping's not going away, but 2021 will probably be less digital than 2020. Even the kids in school. Earlier this year, virtual school was the only option. Kids have already returned to real school. But for a lot of people, for the family that bought 2 laptops, a new internet router, and a new video game system to survive the pandemic, they're probably going to spend a lot less on technology products in 2021. And I think the risk for tech is that that's not in the forecast. Everyone is assuming that, these are long-term trends. 2020 was a great year of growth. Well, 2021 will just continue it. But I don't need another new router. I don't need, once you have a laptop for every person in the house, you don't need any more. So I think 2021 could see a slowdown in tech spending. And I think we're using this as a time to remind us that there's plenty of growth taking place out of the tech sector. Even though a lot of the investing community seems to be obsessed with tech, we need to look at other areas of the market that have been growing and have some really interesting growth drivers where we think they're going to continue to grow. So healthcare, which is still benefiting from an aging population around the world, also we need to spend a lot to be pandemic ready for the future. Healthcare should benefit. Industrials are enjoying improvements in factory automation. Autonomous driving is going to be a huge trend over the next 10 years. Should benefit a lot of companies. There's huge changes going on in the housing sector, whereas baby boomers retire and the large population group of the children of baby boomers starts to enter their 30s and have expanding families. They're going to need new housing, new types of housing, or the appeal of the suburbs is increasing. Commodity sectors, energy and materials, we're seeing a huge growth take place in the middle class around the world in emerging markets. And that's going to place enormous demands on on infrastructure, demand for commodities. There's a lot of growth trends out there, and we think that tech is not the only one. And a lot of the other sectors that are growing are a lot cheaper than tech and offer, I think, a lot better opportunities.
Mm-hmm. Yeah. So let me take it back. So with that in mind, I will give you a quick update on second quarter performance, which is not terribly interesting, and then I'll tell you what we did in the portfolio, and then Greg will just touch on what he did in the growth in international portfolios, and then we'll open it up for questions. So during the second quarter, we saw a lot of relative outperformance and had a nice leg up, a nice spring off of the lows of March. During the third quarter, we did not outperform, but we did still have solid and strong performance and continued to make up a lot of lost ground. So far, we're only 2 weeks into October, but so far we're off to a really good start for this quarter and seeing both absolute performance strong and also relative. So far we are outperforming in October. And I think that's probably the way that we're going to continue to recover and continue to dig out from this, which is sometimes we're going to outpace the market, sometimes we'll be a little bit behind, but it's going to be 3 steps forward, 2.5 back, 3 steps forward, 2.5 back, and we're going to get there because we have portfolios that consist of really, really strong companies that produce incredible amounts of cash flow, and their valuations aren't stretched. They didn't get caught up in that bubble of stories and excitement. They're just marching along, and they're trading at fractions of the valuations that some of them were before, or fractions of the valuations that they probably deserve to be trading at. In fact, as of yesterday, the disciplined growth strategy that Greg manages was actually up on the year. So, yay to that. Okay, I'm going to share with you some slides really quickly from the portfolio, from the dividend income portfolio. These are the new investments that we've made in the last since the pandemic really started. Now, you all probably know Interpublic Group, which we added at the end of September. This is an advertising company. We always put together this scrapbook so you can see who the CEO is. But what I would like you all to focus on is the following. In the upper right-hand corner of this slide, you'll see the share price and you'll see the dividends. The share price is in blue, and you can see the market might jerk the share price around, send it up, down, sideways, wherever. But the dividends are a reflection of the cash flows that the companies are making. And I just thought if we look really quickly collectively at what the companies we've added do in terms of the share price fluctuation and the consistency of dividends, I find it very reassuring, and I thought it would be a nice thing to highlight very quickly here. What you'll see in many of these cases is the dividends sustained even through 0809. So what we have overall is a portfolio of companies that, despite the market being whimsical with the share price, the dividends have continued to march upward. So here's Interpublic Group, and then I'll go in reverse order of I'll go in order, working backwards of what we added. Then there's National Retail Properties, same thing. Stock trends upwards, market jerks the share price along, but you can see how consistent that dividend income is. And again, that cash flow is the best reflection of what's going on inside the company. Here we have Nextera, where we added that preferred, same thing, a nice ladder step upwards of the dividends. Same with Seagate, same with Unum. Viacom, we're going to give them an excuse because that was some merger and acquisition activity, but they've been on a very steady, very consistent trend upward. So that's a quick summary of what we've added. And I hope that seeing the step up in those dividends and the consistency of them gives you all the comfort that it gives me. Greg, would you like to touch on the changes in your portfolios?
Yeah, international, so first on international, we've had a good quarter of absolute returns, up a little over 5%, just below the benchmark. Still down on the year, but making steady improvement on that. And the one change during the quarter, we bought Mitsui, a trading company in Japan, to replace Mitsubishi. But Mitsui, we think, offers a lot of growth potential as Japan's economy continues to move out of deflation, and policies are slow to change, but they are moving in a positive direction, and we're starting to see better growth. And the offers a dividend yield over 5%, and has great investments in the commodity sector and industrials, retail. So as Japan and Asia does well, Mitsui should be well positioned to benefit. Overall, the international portfolio has a dividend yield of 4.3%. Trades at only 13 times earnings, which I think is kind of a ridiculously low valuation, especially since some of those earnings are already depressed if we do get a vaccine or even just better growth in 2021 and a recovery. The portfolio is well positioned to have earnings grow off of that base quite significantly. So 13 times seems quite reasonable. One of the biggest trends we're seeing in international is strength in China, and how China, their economy is above pre-pandemic levels, and how quickly it's recovered and how successful they've been in containing the virus. And that's benefiting their neighbors. It's benefiting a lot of commodity markets. It's benefiting countries like Korea, Singapore, Hong Kong, Taiwan, Japan. So that's a key growth driver for international. Also in the growth portfolio, we made one change. We added Disney. We think Disney is a fantastic company. Was a fantastic company already, and now they've added in the last year the Disney Plus streaming service, with which they've already added 60 million paying subscribers. And that number should grow when they release earnings later this month. For some reason, the market values them less. They have a market cap that's less than Netflix, which seems odd to me, since in addition to a popular streaming service, Disney has the number one group of cable networks. It's got 8 of the 10 most visited theme parks in the world. It's got a movie business, TV studios. There's a lot of good things going for Disney. Trades at a reasonable valuation. We think once earnings recover, earnings could get back to as much as $10 per share. It's trading at just under, I think, $130. So it's reasonably priced, and I think has good growth in front of it. To fund that, we've been trimming Facebook and Teradyne, 2 of our tech holdings that have become too expensive in the enthusiasm for the tech sector. So it's nice to rotate that money into a cheaper company, still tremendous quality and with a lot of growth potential.
Yeah, great. So we will wrap it up and open it up for questions. But just before that, I would, let's see, yes, I did that correctly. Sorry. I want to remind you all that we are cautiously optimistic for the overall market, and we're much more enthusiastic and positive for our portfolios. I had an interesting call with one of my clients this week as we started to review, the third quarter portfolio reviews. And I was reminded of a behavioral economist who I love, who I wrote about in a note probably in April that I sent out to all of you, a guy named Shlomo Bernatzi, who is a professor of behavioral economics at UCLA. And what Shlomo Bernatzi says is, he says, if you want to be a very good investor, you should look at your portfolio statements once a year, not more. And he actually, I think he gave an example in this talk that I was listening to where I think he has his accounts at Morgan Stanley or something. And everybody knows that his whole thing as this guru behavioral economist is, don't look at your statements more than once a year. It's not healthy. It's not going to help you make great decisions. It's going to cause you tremendous angst and heartache in the interim. And so, his Morgan Stanley broker calls him and says, hey, have you looked at your portfolio today yet? And Shlomo says, what are you, crazy? I'm the one who says, don't look at it more than once a year. But it was interesting talking to this client this week, because what I realized is we all could have saved ourselves. I mean, not Greg and I, right? We're professionals. We need to be in the weeds every day, all day, managing the portfolios and staying on top of everything in there. But as our clients, a lot of pain and angst and anguish could have been saved if we followed Shlomo's advice to some degree and didn't look as frequently as we do. I know we're still down on the year besides the growth portfolio, but the improvement that we've seen since those awful, awful days of when we started these conference calls on March 18th has been so dramatic. And with the strong returns that we had in years previously in 2019, 2016, 17, with the strong returns that we had then, overall the portfolios are A-okay. So I do just want to, think about Shlomo and think about how nice it would have been if maybe we'd checked our statements on December 31st and then not again until now. We would have saved ourselves a lot of pain. I know it's not practical. I know it's silly, but I like channeling him every now and then. So with that, I'm going to open it up to questions. We are not going to do voice questions, if you don't mind. I think it's just going to be a lot more organized if we do them via email. So if you want to email me, jenny@gilmanhill.com. John is going to check my emails, so please don't be shy. We've fabricated questions to answer in case we don't get any good ones. But with that in mind, we do already have 2 that one of you emailed in earlier. So I'm going to ask Greg to answer these. So it says, hi, Jen. Would love to hear your thoughts on the threat of liquidity-induced inflation and the drag of our massive and rising national debt and the likely impact of new and increasing taxes in the future. So Greg, you want to grab those ones?
Yeah. First on inflation, wouldn't that be fun if we got inflation? That'd make our job so much easier. And obviously, if we did get inflation, equities would be the place to be, and owning treasury bonds at 0.7% interest would not be the place to be. So I think a lot of money would rotate into to stocks if that was the case. As far as inflation, it's possible. It could happen. The Fed added $3 trillion to its balance sheet, and all that money went to mostly wealthy individuals, and they bought bonds with it. We see the inflows into different asset classes, and it's mostly bonds that are benefiting. So the money is not being used to take risk, or more importantly, the Fed put it out there to be spent. And maybe at some point that money starts to get spent, and then that will drive inflation. But we'll wait and see. That there's been predictions of liquidity-induced inflation for for 10 years now since the Fed started quantitative easing, and it just hasn't worked. It's pushed up asset prices, but not consumer prices. But that could change. But we'd like to see some inflation in the market, and I think the environment of low yields and low inflation is not great for a lot of people in the country. As far as higher taxes, I think it's inevitable. One thing we have been looking at is on international companies. When the U.S. raised the corporate tax rate, it's 3 years ago now, that really hurt the international companies, because in comparison, all of a sudden the U.S. companies got a 15% boost to earnings, and in comparison, international companies did not have that 15% boost. If they're domiciled outside the U.S., and it just, in a momentum-driven market like this, that pushed money into U.S. stocks, and once U.S. stocks outperformed international, it just kept going with momentum-driven investing and people buying simply what's performed the best. So for the last 3 years, I don't have the numbers in front of me, it's been U.S. has outperformed international a lot, but perhaps higher corporate taxes may see that trend in reverse, where international money flows into international from U.S. stocks.
Yeah. Also, I think, I want to grab the spotlight back. I've answered that question a little bit differently too, which is I also do expect that we might start to see inflation. And one of the arguments we've heard is that that's the way the governments are going to decrease the huge debt loads that they've taken on, is to allow inflation to set in, to basically devalue the debt that they've taken on. Greg's right. It would benefit equities if that happens. It would also benefit, I think, hard assets and real estate assets, which we, relative to the broader market, disproportionately own. So that could be favorable for us. In answering that question more broadly, I was chatting with another one of my clients who's in his mid-70s this year. And I said, the thing is, what's going on right now with the increasing debt loads, with the higher taxes, this isn't going to hurt you guys. This isn't going to hurt the 60, I think, to 85-year-old cohort. I think the pain is going to be for my kids, for Brooks and Jack. And I think, and for the kids and the college age kids now, because what it ultimately is going to do is going to impinge, I don't know what the right word is, infringe on our ability to grow in the future. And it's going to be, it might hang over the US like a wet blanket. So I think it's pretty sad to me, but I don't think for you on this call, I don't think you're the ones who are going to be hurt by it. I think we worry about our kids and grandkids for that. Okay, John, are there any other questions that have come in?
Yep, we got a couple that came in. First one, given how poorly value has performed over the last 3 years, are you planning to expand your search for stocks that do not fall into this class? So are you going to start looking more at growthy things?
So we don't actively look for value stocks, right? We're not technically value investors. That's just where we skew. What we look for all three of the portfolios is a high and sustainable free cash flow yield, because what we want is we want companies that can sustain a massive economic decline, like in 0809, or like a or like a March and April of 2020. And what we think is, if you're a company that has strong and sustainable cash flows, you will come out on the other side. We do not want to own anything in this portfolio that has risk of bankruptcy. And that's what we think, that's what we're aiming for. So the reality is we're always looking for growth, and we're always trying to pair the value and the growth. When we're analyzing a company, we're not looking just at the multiple. We're looking at a wide range of factors, and one of them is there earnings growth too? We don't need to have shoot the lights out earnings growth, and because of our mandate to generate, at least I'm talking about the equity income strategy now, generate a 5% or dividend or higher dividend yield, we're never going to buy an Apple or an Amazon or a Google. Their dividend yields just aren't going to be big enough for us. So we're probably not going to own the companies that are generating the 40% plus earnings growth rates, but there are incredibly few of them anyway, and they're overvalued. So I think the answer is no, we're not going to shift our search. We already do look for growth. It just so happens that the companies that we own tend to fall into the value space, but that's not our starting point. Is this a cheap company? Our starting point is always, is there strong cash flow? Is it growing? is it sustainable? Greg, do you have anything to add to that?
No, I think that's, I think you covered it.
Okay. Any other ones, John?
Yep, another question. What will happen if Biden wins and is then declared unable to continue as president?
Okay, in what time frame? Like right off the bat?
Yeah, and I can tell you that constitutionally, in that case, then the electoral delegates still cast their ballot, and they would almost certainly pick the vice presidential candidate as the nominee, and then replace the VP candidate. And if it's after the electoral college is voted, I think the 25th Amendment takes charge, and you have the vice president automatically taking the position.
And do you think the real gist of that question is like, then do we head towards a more socialist? Like,
well, I think that's it. Yeah, I'll let you address the investment and political repercussions of that.
Okay, so this is where we believe strongly in checks and balances of the overall U.S. political structure. So one of the things we've been listening to a ton of political strategists, really, I mean, there are some brilliant minds out there. Who knows if they get this stuff right or wrong, but directionally the way they're thinking has been very helpful to us. And one of the strategists that I listened to, I think it was last week, it was hosted by the Council for Economic Education. And the guy's name is Tom Block. He's at a firm called Fundstrat. He used to be the political strategist at JP Morgan. And one of the things he said is, you know, basically if the Senate goes Democrat, they're only going to have a 2-seat majority, which means that they're, you know, that's very, very tenuous in the next midterm elections, which are 2 years away. And Greg or John, if you think I'm misanswering this question, please jump in on me. But the way I look at it is the Democratic Party knows that they basically have 1 year to make whatever changes they want to make, because that's where they may have a Senate and House majority to back them up. And then at that point, I believe that if things were to go too far left, by the way, I do not think we're going socialist. I think if we were going socialist, Bernie would be on the ticket and they wouldn't have chosen the most, I think the least socialist of the VP candidates that were up for that. So that's not in my statistically probable outcomes. But I think what might happen is, you know, we see a lot of activity in the first year of the presidency. The next year is focused on the midterms. If things get too unbalanced, the midterms swing back to a Republican Senate. That brings balance into the overall government. And we have, as I had breakfast with a friend of mine, who's a really terrific portfolio manager this morning, and I'm trying to think of how she phrased this, but we have, she didn't say hogtie, but we have a beautifully what's the word? Not hogtie, but like, gridlocked. We have a beautifully gridlocked Congress, which I think in that kind of situation, that's probably the most likely outcome. And then we just don't get a lot done for the next 3 years. You guys think that's an okay answer? Should I have touched on anything else? Greg, John?
Nope, I think that's reasonable.
Okay. Okay, any other questions?
Yep, another question on energy. It says, oil's obviously out of favor for reasons around the economy. On top of that, there's a huge ESG move where the pensions and other investors want to be socially responsible. What's your view on the sector and on MLPs? Sure.
Let's see. I almost wonder if to take my bias out of this, I want Greg to answer it, but I'll say a couple of things. One is that the rig counts in the US, so the oil rig counts are actually lower right now than at any point in the data that I've looked at in the last 10 years, and even lower than when oil prices really tanked in a sustainable way in 2015-16. So I think what might start to happen is that oil prices keep, and by the way, sorry, another thing is there's a lot of rationality that has started to come in kind of post that insane fiasco in, I think it was May, right? Well, first it was like the Saudi-Russia oil spat in March, and then the crazy options trading of May that drove oil prices into negative territory. But since then, I don't think I've ever seen oil prices more stable. So I think what we're seeing is a return of actual supply demand. Believe it or not, energy overall, not even just oil related companies, but energy overall only makes up about 2.6% of the weighting of the S&P 500. One of the political strategists that I heard speak, when asked about what the regulation and oversight would be, the response was energy has become so small that it's meaningless. This isn't something that the government's going to focus on too heavily right now. Yes, there's all of the clean and green and emissions reductions, but these aren't the companies that are taking up the spotlight. So I think I think we kind of see some rational supply demand come in, and maybe we do see oil prices drift up. With respect to what's in our portfolio and the MLP question, most of the companies in our portfolio don't actually have any or have extremely low direct oil exposure. Most of the MLPs have more exposure to natural gas, and those prices and demand have remained incredibly stable. Meanwhile, the share prices have been impacted as the overall energy sector is traded down. With respect to the ESG part of it, that's real. That's gone so far already that there's almost nowhere left to go. The valuations on these companies are like 3, 4, 5, 6 times as compared to the S&P 500 that's at 22 times. So I think the pressure of the ESG side has largely played out. Like it or not, there's going to be demand for a really long time. And to a point that Greg made earlier, as emerging countries continue to expand, it's really not that likely that they're not going to be driving cars that are powered by gasoline. That's just still the absolute cheapest method of transportation. John and I were in Nepal last year for our associate's wedding, and it was incredible. I mean, absolutely incredible, the number of cars. And we were talking about the cost of these cars. So they were saying basically to buy like a 99 or something Toyota SUV, it was the equivalent of $70,000 because of all the taxes. And most of the cars over there are cars that probably cost the equivalent of US like $2,500 to $5,000, and that's years of work. So it's hard to imagine that the expensive electric vehicles and the ability to power them are going to take hold en masse to the emerging markets. And I think that will just, whether we like it or not, whether it's good for the environment or not, I think there's going to be tremendous demand for fossil fuels for longer than we'd all like there to be. And as a result, the energy companies are just going to continue to mint cash with depressed valuations. So I think that the trend away from that is just slower than we all like to hope and think, since everybody loves beautiful blue skies and clean air. All right, sorry, I said I was going to let Greg answer it, and then I went crazy. Greg, do you have any thoughts to add? Sorry.
The energy sector, there's still, the energy sector, I think we've always said is quite complex, and that to think that energy equals oil is wrong. And there's still the amount of energy usage continues to grow and will continue to grow. Now, what makes up that energy is going to change over time, but there's still a huge trend of, there's a lot of coal being used around the world, and that coal is going to shift to natural gas over the next 10 to 20 years. Solar and other renewable forms of energy will also grow, but natural gas has huge growth in front of it. And even oil, the oil price, we look at commodities, since the pandemic started, most commodities have rebounded already. And copper's back to $3, but yet oil's not. Oil lingered around $40 a barrel, and is that because the fundamentals of oil is not stable, or is it that the consumers can't buy or have no place to go or to use oil? So once in a post-vaccine world, does demand for oil go up? Probably a lot, and that could boost prices. But over the last quarter, there has been a big disconnect between the prices of oil and natural gas and the share prices. Share prices in the sector have continued to go down despite stabilization in natural gas and oil. And I think it's an interesting time for the energy sector, especially given the history. Anytime you've taken for granted where your energy is going to come from, and you haven't made enough investments in that area, the prices tend to surprise you. We saw that in the late 90s, where companies just didn't invest in new capacity. Then all of a sudden, demand picks up in the 2000s, and oil goes to over $100 a barrel. And natural gas prices were at record highs. So not forecasting that's going to happen, but I think we are probably underinvesting in energy right now.
Yeah. Okay, thank you. John, any other questions?
Nope, that's all I've got at the moment.
Okay, then since we have just a couple minutes, can I answer one of our fake questions that was a non sequitur to the conversation that I just liked? Okay, hold on, let me take the spotlight back. All right, so one thing that I thought was really interesting So here's the fake question, which is interest rates and bond yields. What do you think about those? And last week I was on a call with a really interesting person, a guy who is the head of fixed income sector, multi-sector fixed income portfolios at Neuberger Berman. So this is a guy who looks at all different areas of fixed income investments, municipal bonds, taxable bonds, private credit, public credit, all sorts of stuff. And then he chooses where to allocate. And it was interesting because it was not a sales call at all. It was purely, do me and a couple of my friends a favor and talk to us about this world. And one of the things he said is, in the investment grade fixed income landscape, it is nearly impossible to find true yield over 1.8%. And what he said is that what they're seeing on the institutional side is clients who have to invest in bonds, who have to invest in fixed income. So like big sovereignties, big endowments, who really need to. They're making a choice between increasing the risk of their portfolio to keep the income up or decreasing the expectations for the yield they're going to get. He said most of them are actually choosing to decrease the expectations for the yield. So I thought that was interesting. And the questions that we peppered him with over and over were like, there's got to be some place, and there's got to be some place to get some extra yield and still stay on fixed income. And the answer was no. When they talked about high yield, so like junk bonds, right? What he said there, which I thought was interesting, was in past times, like what we're in now, you can parse through the junk bonds, the high yield bonds, and there will be some really great companies that are just trading at really cheap prices, but that's not the case now. Either it's broken and the yield is high, or there's no yield to be had. And that it sounded to me overall like that whole fixed income market is becoming more efficient and more rational, and that there's just not yield to be had. And then that echoed back to me. We look at these terrific slides from JP Morgan, and they show what you can earn every quarter. They update it, and they show what you can earn on $100,000 invested in 6-month CDs. And today, if you have $100,000 invested in 6-month CDs, your annual return is $220 for $100,000, whereas 20 years ago, that was $6,000. So I just thought that was an interesting thing, unrelated to the rest of what we talked about, but just an interesting vignette for all of you. So I think that's it. So I can't thank you all enough for joining us. Please don't hesitate to email directly with more questions if you have them. And we'll stick with these calls, and we'll see you again. We'll see you again in 3 months after the next quarter call. And let's hope for some continued improvement in the markets as we march out of this. Oh, one thing. Greg made a really great statement, which I loved, which he said, the thing is, well, we have a lot of change ahead of us. We don't really have that much uncertainty. And I think that's true. So when we talk again in three months, there will have been a lot of change, but I think that we know where that change is going. And I think that's really positive for us as humans and also for your portfolios. So thank you so much for joining us, and we'll see you in 3 months, if not.